a financial product is as good as the person who is selling it to us, because we realize the benefits of the product 10-15 years after the product that has been sold to us. I mean, imagine the number of crappy life insurance policies sold to us by our relatives. Hi, welcome to our channel. Please subscribe to our channel, go follow us on Instagram and Facebook, and do not miss another episode of Be Kifaiti. So in today's episode, we are going to talk about National Pension Scheme. So the first question is, what is National Pension Scheme? So a few years back, our government realized that most of the working class people are not doing enough for their retirement. I mean, they're not saving enough for their retirement. The government employees were still forced to put some of the portion of their salary into their retirement corpus, but the private employees were still not doing anything. With the aim of getting more employees to save for their retirement, the government introduced the National Pension Scheme in 2004 for the government employees and opened it for everyone in 2009. To get more people motivated for National Pension Scheme, the government added tax benefits along with the annual return from investing. In short, the National Pension Scheme is a voluntary contribution retirement solution which was launched by the government to help Indians to prepare for the retirement. There are two types of accounts which you can subscribe into under the National Pension Scheme. The first is the Tier 1 account and the second is the Tier 2 account. So what is the difference between Tier 1 account and Tier 2 account? Tier 1 account is the actual National Pension Scheme account which most of you are aware of. It is used for saving taxes, and since it has a lot of tax benefits, it comes with some rigid exit rules. Tier 1 consists of two phases. First is the accumulation phase wherein you keep contributing the money, and the second is the distribution phase where you receive a regular payment from the money which has been accumulated. Tier 2 account is more like a savings account but with variable returns. You're free to make multiple withdrawals and deposits without any restrictions. Tier 2 does not give you any tax benefits, and to be very honest, the number of people who have opted for Tier 2 are not that much. But now the question arises that there are other tax saving schemes like PF, PPF, tax saver FDs. How is National Pension Scheme different from them? So the answer to this question is that everything apart from the tax saving part in National Pension Scheme is different. I'll tell you how. Where in PF, PPF and FDs you get a fixed return, in National Pension Scheme you get a variable return. Think of them like mutual funds, but unlike the mutual funds, the National Pension Scheme charges a fee of 0.01%, whereas the mutual funds can charge up to 2%. Since the inception in 2004, the National Pension Scheme has given an annual return of 9 to 11%. No other fixed return tax saving option has given these kind of returns. Yeah, all of that is fine, but how will you get your money back? Sadly, this is where the National Pension Scheme falls a bit flat. To be simply put, the government does not want you to take out your money before you turn 60, and even after that, they want you to take it as a monthly or a quarterly payment or a pension and not allow you to take a lump sum. You can withdraw from the account prematurely if you need funds. Even then, you'll have to wait a minimum of 3 years starting from the date of your first investment, and the maximum that you will be able to withdraw will be 25% of the total funds. As suggested earlier, the National Pension Scheme matures only when you turn 60 years old. That can also be extended to 70 years old. Depending on the maturity, you can withdraw 60% of the corpus in lump sum, and the remaining 40% you can take as your monthly or quarterly pension. The monthly pension will be considered as an income, and normal taxation will apply to it. Okay, yeah, all this is great, but like, how do we start investing in National Pension Scheme? Okay, so we won't be getting into technicalities, but we'll mainly focus on the important stuff. After you've opened your account, you will be asked to select your pension fund manager, which is the PFM, and you'll have 8 choices to choose from. As of March 2021, ICICI, SBI, UTI and HDFC have been the top performers, and you'll be given a chance to change your PFM once in a year. After selecting PFM, you will be choosing between active and auto investment choices. In active, you can decide the split between the debt and equity allocation. Thumb rule: the debt of your portfolio should be equal to your age. For example, if you're 30, then the debt should be 30% of the portfolio. If you choose the auto option, then you'll have three choices. First is the aggressive, which gives you 75% equity. Second is the moderate, which gives you 50% equity. And the third is the conservative, which gives you 25% equity. Again, thumb rule is the lesser the age, the higher the equity percentage. Just to recap, we have covered a total of 5 topics, starting from the basics of NPS, difference between tier 1 and tier 2 accounts, difference between PF, PPF and national pension scheme, how to withdraw money from your national pension scheme, and also how to get started with it. In the next part of the video, we'll also talk about the tax benefits from the national pension scheme. Till then, be good.